Hi, everyone. Thank you for tuning in. I'm Rick Martin from Fortress Federation Investments, and I'm very excited to present this opportunity to partner with us on this 262-unit value-add property in Webster, Texas, which is a southeast suburb of Houston. Before we get into the meat of the presentation, I wanted to share what makes me feel great about this opportunity. First and foremost, we are partnering again with Lone Star Capital, who are extremely competent and know the Houston market very well. I have a good relationship with these guys and have a ton of comfort and trust in their abilities to run the deal. Secondly, the market drivers are definitely there. As I alluded to in the highlights, Houston was the second fastest growing metro over the last 10 years and is projected to be the second fastest growing metro over the next decade. Based on a study by Cushman and Wakefield. RealPage projects rent growth over the next 3 years in the Clear Lake submarket to be 5%. And with eviction moratoriums ending, I don't feel like this is too aggressive based on the growth of the market. Webster itself is a upper middle working class community with a solid annual median income of $50,000. So right in that sweet spot. That's plenty to absorb the minor value add that we are going to be implementing. It is also a low crime area with plenty of good jobs, shopping, retail, and dining nearby. One final note on the market, I wanted to share a graphic furnished by the Bureau of Labor and Statistics, which dispels the myth that Houston is an oil and energy dependent metro. You can see side by side that Houston is fairly consistent with the rest of the US. As for the deal itself, it has great fundamentals. It has a below average purchase price per door, giving us a great cost basis going in. It has a proven value add plan already built in, which we'll go into detail here in a moment, but it really takes a lot of guesswork out of what we're going to attempt to do. Also, once renovations are completed, we will still be below average comps in the area. So we are not trying to set the bar here. We're leaving ourselves plenty of headroom for future growth. Also, RUBS, which is billing back tenants for utilities, are standard in the submarket, and Solano has never charged for RUBS. So we will begin a program at $35 a door, which is conservative when compared to the comparables. I love deals with strong cash flow. A nearly 10% cash on cash return is very good based on today's conditions, and we still get to participate in the upside. The deal is underwritten, of course, without a refinance to remain conservative. However, we do plan to pursue a refinance depending on market conditions. A deal should never rest on the good financing alone, but having said that, the terms of this loan are amazing. We have a 10-year floating rate of 2.45%, which is unbelievable. And additionally, we have 4 years of interest only, which is enhancing our cash flows. So those are just some of the reasons why I feel great about this investment. And for those of you who are curious, I am putting $100,000 into the deal myself. Okay, so now we're going to transition here into the webinar replay by lead underwriter and sponsor, Mr. Rob Beardsley. And if you have any further questions, please reach out to me directly at rick@fortressfederation.com. And you can refer to our fact page as well, as there are a lot of questions that are answered there. So thank you again for tuning in and enjoy the rest of the presentation.
Okay, so we're talking about Solano Apartments. This is a 262 unit, 1966 vintage multifamily complex in Webster, Texas, which is in the southeast submarket of Houston, Texas. Solano fits perfectly in our wheelhouse. This is a class B- apartment complex in kind of a B+ area in a very strong, booming population growing submarket that is primarily workforce and renter by necessity. And we'll kind of dive in a bit deeper about kind of our thesis and why we think that is really the right place to be today. But focusing on the background on Solano and the story, Solano was originally purchased back in 2008 by the current owner. It was the first property that the partnership purchased, and it is the first property that this partnership is actually ever selling. So this is a really rare opportunity to acquire something from a longtime owner. It's rare when you can actually buy something that has been owned for over 10 years. So it does two things for us. It's an exciting opportunity for us to come in, put fresh management, fresh capital, fresh take on the deal, as well as because of the true off-market nature of the acquisition, we've been able to put the property under contract for just under $97,000 per unit, which we'll show you the sales comps in a little bit, and you'll see that we're pretty much at the bottom of the pack with properties all around us trading for higher numbers. So as I mentioned, this property is situated in Webster, which is in the Clear Lake submarket, which has been a really strong growing submarket, and RealPage has this area projected to grow 5% per year, increase rents 5% per year for the next 3 years. So that's our big headline. Really exciting growth, and that makes for a more conservative business plan where we don't have to necessarily implement a huge renovation or a huge turnaround to get still high returns, because we're benefiting from the growth in the area. So as I mentioned, Solano sits in the heart of Webster. It's right next door to the high school, across the street from the elementary school. And then we've got lots of healthcare presence. Healthcare is the predominant employment base in the area. And then the NASA Space Center is a 6-minute drive. And we'll show you the flyover and all of that. And another thing to point out is we've got Baybrook Mall, which is a substantial retail center just about 1.5 miles away, which actually does the second most sales in Houston on a per foot basis, which is obviously no small feat given Houston is the 4th largest city in the country. So with that being said, another key element of the business plan is that this property, though it's not in a flood zone, it flooded in Hurricane Harvey back in 2017 due to local drainage issues, which were since remedied. And Clear Lake has invested nearly $500 million in kind of mitigating those risks for future flooding. And notably, this property did not flood in Imelda in 2019. And again, want to reiterate, this property is not in a flood zone, but we are purchasing flood insurance, obviously, to mitigate that risk. So the property itself has roughly half and half 1 bedrooms and 2 bedrooms with a sliver of 3 bedrooms, which is a pretty standard workforce housing unit mix. And this property generally has above average unit sizes with an average square footage of 900 square feet. So 2 things that the property lacks is, number one, rubs. This is a really big thing that makes the deal stand out in the submarket in a bad way. All the competing properties in the area bill back the residents for utility usage. However, Solano uniquely is an all bills paid property. And all bills paid is usually associated with a lower demographic and, obviously doesn't maximize the NOI of the property. So our business plan includes implementing a RUBS utility bill back program where we'll be billing the residents back for utility usage, which obviously does 2 things. It drives additional revenue for the asset, as well as it makes the residents more conscious of their usage and ideally brings down utility usage from where it is today. We're not underwriting any utility savings, but that is usually the goal when you go and implement RUBS. The other thing that the property lacks is a more modern amenity set. So with a large apartment complex like this, you typically see, especially with the newer assets that we might be competing with, you typically see a more robust amenity package. And this property currently only has a playground, swimming pool, and 3 laundry facilities. So our business plan includes adding a package locker in the leasing office, an outdoor kitchen and grilling station by the pool, pool furniture, adding a pop of color to the pool. We'll show you pictures of the pool. Dog park, fitness center, business center, all things that are, come to be expected and will make the property more competitive with the general neighborhood and hopefully increase resident satisfaction. So with all that being said, we are projecting nearly 10% average cash on cash over a 5-year business plan with total returns of 16.8% 16.8% net IRR to investors over that 5-year hold. And I think the most impressive number here is the year one 8.7% cash on cash. And that really strong 8.7% cash on cash in year one is only dependent on a 2% revenue increase over the in-place numbers. So we're not making any crazy assumptions in year one that we're going to, implement RUBS right away and renovate all these units and then double revenue just to hit our returns. We're actually pretty much keeping revenue the same and actually raising expenses slightly over the seller's expenses. So that really shows you the in-place yield potential of the asset, which is really a rare thing where you're able to buy strong in-place yield while still have the upside of the value-add business plan. So as we discussed, this property is in the Clear Lake submarket. We'll just kind of reiterate some of the strengths of the market. So it has a diversified employment base, healthcare, education, NASA, and there's actually no real oil and gas presence in this particular submarket of Houston, which is obviously a concern for many investors investing in the Houston market. Something important to note is that this area of Houston, the submarket, actually the rents grew 2.6% in the last 12 months despite COVID. And if you analyze the data, there's, on average, many submarkets actually rents declined. But these strong renter by necessity workforce housing submarkets have only gained in strength. And we think that's a trend that's going to continue and was exacerbated by COVID. And this is where we want to be. We want to position ourselves by providing that workforce housing that is in that perfect sweet spot where there's a lot of population growth, there's job drivers, and there's that positive growth. Yet it's not too hot of a submarket. It's not too sexy where the developers are coming in and overwhelming the submarket with new supply, stymieing all the potential rent growth. So that's really the sweet spot. Obviously, you can invest in somewhere where it's workforce housing, Class C, but the population is declining, and that doesn't do us any good. So, and nor does it really do us any good if we're investing in the Galleria or downtown where rents have declined 5% because there's so much new supply and then there's an exodus to the suburbs. So we think we're perfectly positioned with this asset to continue to capitalize on these long running themes of renter by necessity, suburban workforce housing. So as I mentioned before, the first floor units during Hurricane Harvey, the first floor units flooded, and the seller was able to capitalize on an insurance claim to renovate those units. And he renovated them to a higher standard than the second floor units. And those units today are commanding a rent premium of anywhere from $90 to $110 per unit. And so our business plan is straightforward. You'll see the before and after picture. We're going to go in, renovate the second floor units to that first floor unit finish and capture that $90 to $110 rent premium across the asset. And as I mentioned before, coming in with the amenitizing the property, bringing it up to par with its competitors. And before I jump into the financing, Charles, you want to add anything on the market or the business plan?
I think you covered it pretty well. It's diversified. It's got all the different things going on. It's got, education. It's got the healthcare aspect, and it's also got some of that kind of sexier high tech stuff going on as well.
Absolutely. So definitely a big highlight for us is the debt on this deal, actually. So because of the affordable rents that this property has, Freddie Mac's mission-driven business model is to provide financing to providing affordable housing to our country. And so they pulled out all the stops, giving us the best pricing on this deal. And so we're getting a 10-year term floating rate loan with a starting interest rate of 2.45%, which is really the best terms I've seen, coupled with 4 years of interest only, really makes for very, very strong cash flows. And embedded in our underwriting and the projected cash flows that we're discussing is the market projections for future interest rates. So we're already baking in the market's expectations for interest rates to rise over the next 5 years. And the data actually supports that the market usually overestimates the path of rising interest rates. So we may benefit from rates staying lower for longer and we'll have higher cash flows. Conversely, of course, if rates raise faster than market expectations, then due to the floating rate nature of our loan, we will have lower cash flows. We are purchasing an interest rate cap that puts a ceiling on our all-in borrowing costs to 5%. And even at that 5% number, when we amortize in year 5, we still have over 5% cash flow. So even at our ceiling interest rate risk exposure, we still have positive cash flow and we're able to pay principal and interest on the loan. And really the most important aspect of the debt that many people overlook is the flexible prepayment penalty. So with Freddie Mac floating rate debt, the prepayment penalty is 1%. And that's a very cheap prepayment penalty that really gives you the maximum flexibility to prepay the loan via a refinance or a sale at any time, really. And so in our opinion, what this allows us to do is it maximizes our opportunity to create value either through a sale or a refi, whether that be in 2 years or 7 years. And it also mitigates our downside risk where if we're not going to be forced to sell this property subject to assuming the existing loan, which can impact pricing negatively. So we'll be able to sell this property free and clear to the new buyer, which typically allows you to command the highest price. So with all that being said, our initial value add business plan of renovating half the units, amenitizing the asset, and implementing RUBS, we're projecting that to complete that in roughly 18 months, and then continue to enjoy the elevated cash flows throughout the 4-year interest-only period of the loan, and then consider a refi or a sale in roughly 3 years based on market conditions. And, of course, we're underwriting this to a 5-year hold period, but generally we're saying a 3 to 7 year projected hold period with a very high likelihood of a capital event being a refi. I'd say somewhere around 3 years. So this slide, we're introducing the deal structure. And so the highlight here is our 8% preferred return, which is an IRR-based hurdle. And so what this means is the priority of payments are first, 8% is paid to investors. And then secondly, 100% of investor capital is returned. And only after that, the remaining profits are split at the promote rate of 70% to investors and 30% to the manager. So this is unique because most of the time you see deals that have a simple preferred return with a cash flow promote, whereby the sponsor is taking a piece of the cash flows. In our deal, we are distributing all cash flows available to the investors, and only really upon sale are we monetizing our promote. And this obviously does two things. For cash flow investors, this maximizes your cash flow, which a lot of investors really appreciate. And number two, maybe even more importantly, is it's a downside risk protection for investors, because we're not going to earn performance compensation until you've taken all your risk off the table and you've received all your original investment back, plus a cumulative and compounded 8% return. So just to reiterate that, the preferred return is cumulative and compounding. So if in a given period we pay only 6%, that missing 2% is actually going to accrue to the following period and earn 8% on that missing capital. The other thing to point out is the equity multiple is nearly 2x over a 5-year hold. So when you add up cash flows and profits upon sale, you're looking at nearly doubling your money in 5 years. So here's a quick overview of Solano. Here's the asset. As I mentioned, you got the high school next door, middle school, the elementary school across the street. Here's NASA Parkway, which Solano's entrance is on, and main frontage right here on NASA Parkway. And then just out of screen, a few blocks to the west, you have 45, which is a major highway in Houston, which gets you access to Beltway 8, which is the loop. And then you have 610, the inner loop, and 45 actually takes you right through both of those into downtown. So we'll get a better look at that soon. So looking at the interiors, here we have the look. These are actual pictures of the units, both classic second floor units and then upgraded first floor units. You can see they did a really nice job on the first floor units with, in my opinion, super attractive backsplash. They've got the upgraded hardware on the cabinets. They've got the gooseneck faucet, upgraded countertops, new appliances, modern flooring, gray paint. So they didn't go crazy. We're only budgeting $6,000 per unit to achieve this renovation, but you can see that this definitely justifies that $90 to $110 rent increase. As you can see, going from, those classic floors, white appliances, kind of ugly cabinets. So some of these second floor units haven't been touched, since 2008 or maybe even older. So another rare chance to get your hands on super classic units. A lot of people are doing value add, and they are, these properties become Frankenstein value adds, where it's been value added then again and again and again. And, so it's really a great opportunity to be able to get your hands on, like I mentioned, untouched units for over 10 years. Now on the exterior, the major systems are in great shape. The roofs are pitched, replaced in 2009. The aluminum wiring has been pigtailed and also in certain cases been replaced with copper. There's 3 boilers on site that have been replaced in 2006, 08, and again in 08. So all relatively new, and there's active service contracts to keep those in good shape. Same goes for the chillers, replaced in 2014 and 2017. So everything's, the major mechanical systems, which can really add up on the CapEx side, are in good shape and well maintained. So as we discussed before, the amenities, you can see this pool has great potential. It's a very big pool, and it doesn't, we've asked them where the pool furniture is, and there's no answer. So it doesn't take a genius to bring some umbrellas, get some pool furniture, pop of color. We're also spending a little bit of money to on the decking to improve that as well. And then on the amenity side, we're adding the outdoor kitchen and picnic table right by the pool, the fitness center, dog park, business center, and package lockers, all things that, like I said, people come to expect and appreciate on these properties to help make it competitive for leasing and resident retention. So just to recap, want to emphasize the off-market, low basis nature of this acquisition. We were able to keep this property away from an aggressive bidding war, as this property was quietly marketed to a few buyers. We were able to, Kent and myself were able to come on site, spend over an hour at the property with the seller, get to know him. It's a very old school partnership. They had to get the approval of every investor, all 12 investors in this asset to approve the deal, approve our terms. And so it was a very, closely marketed process. And then, of course, our business plan includes completing the unit upgrades and then capturing the RUBS revenue opportunity as the property is currently all bills paid. And just to give you an example, we're underwriting a $35 per month per unit bill back. And Vibe at Clear Lake, which is a comp right across the street, is currently averaging roughly $88 per month in RUBS. So we think there's maybe headroom in our underwritten RUBS, but we're planning on phasing that in over time. So hopefully there's some upside. So with all of what we're doing in terms of renovating the units, capturing the RUBS revenue, we're looking at a potential value creation of $5 million at a 5.25 cap rate. So here's a quick look of the Webster submarket. As we mentioned, rents have grown 2.6% over the past year in spite of COVID, and rents are now at all-time highs and are projected to continue to grow 5% per year over the next 3 years. So here we have a look at the economic drivers of the area. We've got the Houston Healthcare Clear Lake Center there, NASA just below it, and that's got 11,000 jobs. University of Houston Clear Lake was just brought online in 2019, and also the Baybrook Mall, as I mentioned, with impressive sales. And so you really, with Webster and where Solano sits, you've kind of got a city unto itself, where you've got your entertainment, you've got your jobs, you've got your schools, but you still have access to Houston proper, and you can get into downtown or really all over the city. Here's another look. Charles, anything to add on any of this?
Yeah, well, I mean, you can see, so there's in this perspective, just at the bottom of the slide is the physician's hospital. So, I mean, there are a bunch of different medical complexes in Webster. So it's not just it's not just the HDA Houston, it's also the Houston Physicians Hospital, lots of medical offices, independent practices, all just kind of clustered there. So this is like a kind of a, maybe not quite all of Houston, but like for the Southeast, this is kind of a regional center.
Cool. And so as we mentioned, you can see here, if you can follow my mouse, here's the 45. We're just 2 big blocks away from 45, which takes you right up into Houston proper, gets you access to the inner and outer loop. And then here's the mall here. We've got, very importantly, we've got Costco nearby. We've got Walmart. And then obviously the mall has major brand names as well for all the retail. And here's that look again. Here's 45 taking you right into downtown. Also, you're close to the water as well. So you're kind of halfway between downtown as well as going down south to Galveston, the beach. So here's a look at the rent comps. As I mentioned before, here's Vibe at Clear Lake, number 7. This is the property that's billing back roughly $88 per unit per month for RUBS. And of course, we're currently all bills paid, so $0 per unit per month in utility bill backs. Number 10 right here, this is Baystone. And this property just recently traded for $102,500 per unit. So definitely helping support our acquisition basis. And as you can see here, our plan is not to change the profile of the property. We want to continue to keep it as workforce housing and being in the middle of the pack. So you can see we have comps here that Solano is decidedly superior to, and we also have comps that are newer in vintage and nicer properties. And our pro forma rents, meaning after we've renovated them, are still staying below the average of the comps on both a 1-bedroom basis as well as the 2 beds. You can see the 2 beds average comps $1.20, and our pro forma is $1.17. On the sales comps, as we mentioned before, we think we're getting this deal at a great basis, acquiring it at a going in nearly 5% cap rate, which is super rare these days. And you can see on a both dollar per unit and per foot basis, we are below the average comps. Here's a quick look at our CapEx budget. As we mentioned before, we're budgeting $6,000 per unit to achieve those interior renovations. And then we're handling just some very minor deferred maintenance on the exterior. And then really focusing on those amenity upgrades, as mentioned before, the dog park, the outdoor kitchen. I think dumpster enclosures is a nice one as well. The business center, package locker. So, we think those are strategic CapEx items that are going to yield to the maximum value creation. Here's a quick look at our pro forma. So right here, this T12 column, this is the in-place financials, tax adjusted. So we're putting in what we project to be the future taxes. So we're normalizing those tax expenses. And so you can see on a revenue basis, we're only increasing revenue 2% over the trailing 12 months. And then on the expense side, we're raising expenses just a touch. And we're still able to achieve those 8.7% year one cash flows based on these projections. Another thing to point out, you can see us phasing in the RUBS. We're not going 0 to 100. It's going, roughly I think $15 per unit per month in year one as we phase it in, getting up to $35 per unit and stabilizing, from there. So here's a quick look at sensitivities. We won't dwell on these, but feel free to review these on your own time, and I'm happy to walk through anything that doesn't make sense or you have further questions. One thing to mention on these sensitivities, these are the cash flow sensitivities, and you can see that these cash flows are resilient to a very strong degree. So for the first year, we're projecting that 8.7. But if bad debt picks up and if vacancy ticks up slightly, we're still over 8% cash flow in year one, which is obviously a very good thing. And then same thing on the 5-year average. Again, the downside scenario with bad debt picking up substantially and occupant and vacancy rising modestly, still over 8% cash flow. And that wraps it up. I'm gonna rewind back to the highlight slide, but at this point, Charles, let's take some questions and wrap this thing up. So Matt says, any other projected building on the lower right of the screen planned or close by? Charles, on your end, do you want to pull up the CoStar? I don't think there's any proposed new construction in the area. I think that's something that we maybe touched on, but this area historically has seen a low new supply, which is obviously what allows that supply and demand imbalance to occur and very strong rent growth to materialize.
Yeah, so I mean, per CoStar, there's one property currently under construction in a 3-mile radius. It's kind of pretty far to the northwest, actually. It's closer to Friendswood. And also I think with this kind of tenant base and this sort of product, we're fortunately, not really competing with the new supply, right? I mean, we're going to have, we're going to be much more affordable, and we're going to have, stickier renters as well, who have, this is one of the best options available.
So Yuri asks, are we concerned about the aluminum wiring? No. This property has been around for many decades, and the aluminum wiring has all been remediated. So there's really nothing that would, give us concern. We do own other properties that have remediated aluminum wiring. So another question coming in about insurance costs. So yeah, insurance is something that is killing many deals and is very important to get ahead of. And so like every other deal, we've gotten this deal priced out by our insurance brokers, and thankfully, because this property isn't in a flood zone, flood insurance is very cheap. So that's a big positive.
And I guess that also covers the Gulf and hurricanes question to some extent. I mean, it was so that the Harvey situation was pretty exceptional, and there have been like very local drainage improvements near Solano, and then there have been, as they were saying, the I guess 420 million or so of projects, both federal and state or local as well in the area. In Clear Creek specifically, this is the Clear Creek watershed. I think it's many billions across Houston, but just in the Clear Creek watershed is over 400 million. And more recently in Tropical Storm Imelda, which I think was the 5th most rain volume or whatever of a tropical cyclone, that was in 2019, and this property did not flood during that. So
yep. So what can you tell us about crime in the area? Not a lot of complaints, not a lot of issues at the property specifically. This property, I don't know, Charles, do you have any insight on the demographics and the crime?
Yeah, I mean, I think this isn't really like a kind of a crime type area. This is more of a kind of like kind of middle to upper workforce type of area. So I'm just trying to find the.
Yeah, while you're looking for that, I'm going to talk about the exit cap rate. So Alan asks a great question about is it too optimistic to underwrite a 5.25 exit cap rate? So our answer is no. Obviously, we have to defend our numbers, but based on our knowledge of the market, and specifically, we Charles and I actually recently held a webinar where we went through our Q1 2021 deal flow. So we looked at over 100 deals in the first quarter of this year, and we inputted about 61 of those into our trade tracker, where we put in the data of us fully underwriting 61 of these deals. Over half of them were off market. And we tracked metrics on all these deals, such as the pricing guidance from the seller, the price that we would purchase the property at, the cap rate of those respective prices, the yield on cost of those respective prices, the internal rate of return, and so on. And so we could see the direct spreads between stabilized cap rate, going in cap rate, and this and that. And so, most of the deals we're seeing the pricing's in the low 4% cap rate. And this is all for the similar type of property that we go after, just like Solano. So we see deal after deal, and it's not anecdotal. It's in the data. We can share with you that Q1 data report, as well as the webinar that we held. And you can see that, when you really underwrite with true expenses and real numbers, the cap rates are very low today, and you cannot, in a quality area like this, you cannot get your hands on a 5.25 cap rate today. So that makes us feel comfortable about our exit cap rate.
So I guess as far as the demographics, the block census block income, I think it's the 2018 American Community Survey, is 50,200 per year. So it's pretty solid kind of upper workforce, maybe you call it middle income kind of area. With diverse sorts of people living there. And the town of Webster is kind of a little more, blue collar, but actually the broader area is much better even than that. But, this is, so this is like among the lower that you'll see in the Clear Lake kind of submarket, but really this is pretty good as well. So I'm just looking at
sorry, go ahead.
Well, we have some 911 call lists here from 2021. There's just not a lot of violent crime. 51 private tow repossessions. That's
the biggest one.
Yeah. So I think.
So David asked about the impact on current occupancy when you implement RUBS. So, a question I got last night was how do you actually go about implementing RUBS, and do you do it on existing tenants? And so the way that we do it is, upon lease expiration, for the renewal offer for the current tenant, we will implement that RUBS, and it'll be their choice, obviously, to stay or leave. And as David implies, that could impact occupancy negatively, but we're making our decisions based on the comparables in the property and comparables in the market. And so, looking at all the other properties in the area that do bill back for RUBS, it's odd that we don't. And by implementing it, we're really just bringing ourselves up to the market standard and not taking ourselves from market and trying to push beyond, we're not pushing the envelope. We're just bringing up a deficiency up to market. Are we converting existing units for the new amenities? So the answer is no. The property currently has a very large and attractive leasing center with double height ceilings, and is a lot of underutilized space. And so part of that space will be used for some of the planned amenities. And there's also on the second floor, on top of one of the laundry buildings, there's an unused clubhouse space that is currently the top candidate for the fitness center conversion. So no units for amenities at this moment. Obviously, dog park outside and package locker in the office.
Question about kind of investing and sort of increment of investment size. Is 100,000 increment or whatever.
Yeah. So the minimum investment is 100,000, and from there, I think we can be pretty flexible if you want to invest 125,000, 150,000. I think if I think we could even accommodate some, some smaller or more odd amounts like 110,000. But yeah, $100,000 is the minimum, and just have a conversation with us to see what you're looking for. Alan asks about the extra parking space around this property. Yes, and something that we aren't factoring in or banking on is the potential to purchase the land next door to the asset for very cheap. The landowner, it's just a small strip of land that's not really able to be used for anything. But if we could acquire that land, we could actually increase the number of parking spaces that we have on the property. So that is a potential, but currently the property doesn't suffer from parking issues, thankfully. But still, nonetheless, we know that would be accretive for the property. Okay. Well, if there are no further questions, thanks everyone for being on. Really appreciate your time. Talk to you soon.